Hey, everybody. Before we get started, I'd like to ask you to purchase my new book. It's called Exit Ready Marketing, and it's already a #1 Amazon bestseller. And it covers all the core concepts that we take our clients through here at How to SaaS. It's a great read for founders, investors, operating partners, and marketers. And there's a ton of value that you're going to be able to bring back to your respective companies based on the content that's inside this book. So my ask is go buy the book. It's available on Amazon and on your Kindle, on Barnes & Noble, and even Apple Books. Give it a read. Let me know what you think about the content, and hopefully it helps you grow your respective companies. So with that said, let's jump right in and enjoy today's podcast. Welcome to the Private Equity Value Creation Podcast, where we interview leading investors, operators, bankers, and advisors to help you answer one question: how do we increase the enterprise value of our companies? My name is Shiv, and each episode I will dive deep with a guest to help you become a better value creator and capital allocator. So with that said, let's jump right in and let's get started with today's episode. My guests today are Mohammad Rasouli and Philipp Reineke, and they are both AI experts, and they work out of Stanford and as researchers and have done a ton of work in the AI space, and especially in terms of how AI can be leveraged in the investment industry and in terms of sourcing deals, how you vet deals, how you figure out how to optimize your investments, and then ultimately how do you exit those investments at an optimal time. So it was a really interesting conversation because they're very knee deep as PhDs in this space to figure out all the different applications of AI and on a theory level, and also thinking about all the different applications where the AI can actually be leveraged. And in my conversation with them, I try to take that theory and work with them to figure out how PE investors, investment bankers, and even founders can leverage a lot of this data and these tools to get to better decision making when it comes to deploying capital. So there's a ton of great insights, and they share a lot of great use cases and how this whole process of sourcing deals and actually investing in deals can become way more efficient with a lot less waste and driving a lot more alpha ultimately for funds. So a lot of great takeaways in it, and I hope you take away the same as well. So with that said, I'll leave you right to it. Enjoy the episode. All right, Mohammad and Philipp, welcome to the show. How's it going?
Thanks, how are you?
Thanks for having us here.
Yeah, excited to have you both on. Obviously, AI is a very hot button topic in the world of B2B technology, and also in investment companies and firms, and how they're looking at targets and where they're deploying their capital. So excited to hear your perspective on this. Why don't we start with Mohammad, your background, and then Philipp, you can go right after that, just to give the audience an idea of where you're coming from and what you're bringing to the table here.
Sure. So I did my PhD in electrical and computer engineering. It was dual degree with economics. My research back in the days was on AI for marketplaces, especially two-sided matching markets. I continued that work, and I worked in Microsoft. I worked in McKinsey for 3 years, off of the New York office, where I was managing the AI transformation of some top private equities. I back in Stanford about 10 months ago as a researcher, where I do continue the same research, and most of my time, majority of my time is spent on AIx2, which is AI for alternative investment, with a group of Stanford PhDs and industry experience on the same vision of transforming alternative investment with AI.
That's awesome. Philipp?
Cool, yeah. So I'm Phil. I'm a graduating PhD at Stanford. Much of my research has been in kind of how to use AI to make managers and the researchers more effective. I did some business degrees, degree in computational social science before that. Worked in consulting, lots of startups, including a German unicorn and a YC company. Did some work in real asset tokenization, and that's how I got into alternative investment, and joined Mohammad at AIx2 now. And we did a study with AIx2 in Stanford where we interviewed more than 250 fund managers on how they're thinking about AI transformation, what they're doing. I got lots of learnings from that.
Yeah, and this is such a broad topic, right? AI in the investment world, like there's so many different applications and places to use it. So, Mohammad, can you narrow that focus for us a little bit and talk about where funds or investors can likely deploy AI even today and see a return on it or see operational efficiencies or improvements overall in terms of their regular course of business?
Mhm. Exactly. So when you think about this area of AI impacting alternative investment, as you said, it's a broad set of impacts, especially with the omnipresence technology that we have these days. The way that I would like to bring it to fund managers to structure the way they look at AI, coming from many conversations we had, is to put it in two camps. Number one is AI used for internal use cases, being a better investor, and number two is for their portfolio companies. And I would say like 2023, when I was in McKinsey, it was 50-50, like the amount of questions we got from private equities for internal AI transformation versus their portfolio company transformation of AI, which is both very important. Now, when it comes to internal transformation with AI, which is using AI to become better investors, the first camp, there that itself contains of two category of use cases. The first one is the operational efficiency that you also mentioned, Shiv. It's about how I can write my investment memos faster, how I can run a due diligence in a more timely basis and more efficient way, how I can have my LP reporting, LP queries, my portfolio monitoring of the KPI monitoring of my portfolio companies, market trend analysis, all of these things, doing them in a better, faster, higher quality way with AI is the use cases on the operational efficiency. And there's a second camp within the internal use cases of AI, which is finding the good opportunities in the market, finding alpha. It could be a good asset, good deal, or even a good fundraising opportunity that you are looking for as a GP. Or if you are an LP, finding a good GP that you can deploy capital to. Now, if you look at this lens of use cases, the structure, it can help the managers to decide which camp they want to start from because it nicely matches to the underlying technologies.
And where do you see the bigger opportunity? Because obviously, internal efficiency is something that is important, but the entire business of PE firms or investors in general is to deploy capital and find deals and win deals, right? So is it more so in the winning deal side that you're gonna see more of this kind of investment, or is operational? I know you said it's 50-50, but do you see that continuing?
So that has been within the internal operations, within the internal use of AI, internal to the fund. 5 years ago, majority of the funds who started using AI, they started from finding alpha in the market. It's predictive AI. It's using a lot of recommendation systems. It's using Crunchbase and Preqin and other data sets to search for good deals in the market. That's the nature of the work they were doing. And that was a very tempting idea. Like 5 years ago, when big funds, all the funds above $50 billion asset under management, they started this. The promise was that if hedge funds can do quantitative trading, if Amazon can have a recommendation for consumers, if Netflix can have a recommendation for media, why can we not have a recommendation for private investment, for private equities, for alternative investment? That's a very promising, tempting idea, right? But now, these last 2 years, just because ChatGPT, Anthropic, generative AI has become so commercially available and has been a U-turn in the AI generally, but also in the application of AI for alternative investment, most of the funds have started from operational efficiency. They have tried to focus, double down on operational efficiency, which is writing their due diligence, running their investment memos, doing their LP queries, market trend analysis, monitoring of the KPIs of the portfolio company. And that's because it's now more available, low cost, easy win, which is important not only because of cost and time, but also because of cultural readiness of the fund. If you have one, two use cases that are priority and you can win them quickly and have organizational adoption at high level, that sets the path for the future AI use cases, including the predictive ones that I mentioned.
So let's talk about each of those things, and let's start with the deal sourcing side. And maybe Philip, this would be a good place for you to jump in. On the deal sourcing side, how can you leverage AI to find better investment opportunities?
Yeah, exactly. And I think there's like there are different ways in which you can leverage AI, and different ways in which you can leverage the different types of AI. So we're talking about AI, but AI is actually like you have different categories of it. You have the predictive AI, And predictive AI is basically taking structured data and predicting something from it. And then you have generative AI, and generative AI is kind of working a little bit differently. They're basically predicting words. They work really well with unstructured data. And the nice thing that you can do now with the generative AI that we've gotten in the last couple of years is you can really take this this unstructured data and the structured data together and use both of these to figure out what deal like you should get. And that's really giving us some advantages that we haven't had before. So the whole predictive AI that's been used in the last couple of years, that is basically limited by the data availability in the databases like Preqin and so on. And now what we can do is we can take all the available data and really help finding deals. And so we've talked to a couple of VCs actually recently, who are trying to build completely data-driven VC funds. So VC funds that don't do, even for really early stage deal sourcing, they completely rely on data rather than any kind of like manual processes. And people have been trying this for many years, and now it actually seems to be happening. So there are some funds that claim they have success with that ability with that automated deal sourcing because of the things that generative AI has brought in the last couple of years.
What kind of factors are those models looking at? Is it just core business metrics like revenue, growth rates, EBITDA margins? Like, how are they determining whether the viability of an investment, and how is it doing that accurately? Help us understand that.
Well, I think there are different things. So first of all, of course, they will look at all of these metrics. I mean, for the earlier stage you go, the less these metrics are actually available. But for kind of like later stage deals, they will look at that, and then they will be able to use kind of data that is unstructured, like random stuff online, basically, or not so random, but like newspaper articles, like different social media, and integrate that to infer missing data from this structured data, but also to kind of to enrich the data and to even kind of calculate parameters that you wouldn't even think about. So if you have like a big machine learning model, it will calculate like parameters from the data that is being fed into it. And sometimes these parameters, they respond to something that you can actually like interpret and that is like kind of human interpretable. And sometimes it will just make some kind of random features and random variables that are very difficult for humans to determine, but that sometimes are super like predictive in how good a deal is. Yeah. And then once you have all of this data together, the other thing that you need to do is to basically match it to the firm's kind of portfolio strategy. Look at like, what does it do to diversification and so on. So just having the data and just using AI is like one step, and then the second step is doing a recommendation system, which is like one of the things that we're building at the moment for that reason, because like you need both of these things.
How close is that? And I'm asking for my benefit and even the audience, is just how close is it to, let's say a human were to look at that same data set of structured and unstructured data versus the AI looking at it? How different is the decision making, or how much faster is it? And if it's faster, fair enough, but like how accurate is it to how a human may make that decision, or is it even better than that?
I mean, ideally, it's going to be better than that.
Yeah.
Of course, like, lots of engineering is going into that. So I don't expect there to be like a database that is like, perfect in the next 3 months or so. But then, there's improvement happening. So at some point, I think it's going to be of higher quality than what humans would do looking at this, just because you can take so much more data into account. And because like at the moment how we look through these databases is basically in a hierarchical manner. We define like 3 or 4 of these parameters, and we're like, okay, so we've got like I don't know, AUM of the fund if we're a private equity, or an LP who's looking for a GP, even like, AUM of the fund, and like how long has the manager been active and so on. And these are these like hierarchical filters that you can use to basically narrow down the deals. And if you do this with an algorithm, you can just filter on like much more on kind of parameters that you can't even define, that are just being inferred by like, how how your previous deals, like the previous deals that you invested in and so on. So that alone makes it kind of potentially superior. Yeah.
Yeah. And Mohammed, this would be a follow up for you. Is just, one of the places where my skepticism or the way I think about it is that there's definitely an element of science, but also definitely an element of art here of trying to figure out which companies are going to be more successful or which companies are actually going to break through the noise and be able to get the kind of traction you need to succeed. So how does AI factor into that, and how can humans leverage it better to kind of fill that gap? Because that element of the art component is kind of hard to duplicate, it feels like.
Yeah, that's a very good question. Even if you talk to an investor, and we have talked, as Philip said, to 250 fund managers, and you ask them, describe your thought process on how you choose a deal. Some of that is the like high level categories like AUM, geography, and others they can describe to you. And part of that they cannot even point out to is purely intuition. They cannot say exactly what was the feature. And that's basically the beauty of the deep neural networks as well. If you feed in enough data of the decision of the investor in the past, the neural network is going to find that complicated pattern that cannot be described in a simple term or simple metric, right? So the way it works in the language of algorithms and engineering and machine learning is that if you get enough historical data from an investor or just have targeted interviews with them, show them like multiple sanitized deals, historical deals, and see if they pass or take it. From that amount of data, you can have the pattern recognition with deep neural networks that in a black box way can replicate their thought process. Again, they may not be able to point out the simple metric on how they use it, and the machine will figure that pattern and what that metric is, like interpreting the machine and bringing that is another set of like engineering work to now go back and see what was that metric that the machine picked up. But that's the beauty of deep neural networks, if you give enough data to that.
Yeah, I guess, and just as a follow up, some of that data, in order for an AI to be trained on it, it actually has to be available, right? And to actually be able to learn the patterns so that you recognize it in the future. I feel like a lot of the components that come from expertise or intuition or like the art side of this is not in any data set. So how does the model get around that? Because it's not even in the training data.
Yeah, that's a good question. Some funds do have like a lot of historical data, like EQT has it, right? They claim like 140K historical due diligence, right? That's a lot of data. For the other funds don't have it, there are two ways to do that. One is you can literally look at the history of all the successful and failed investments, even out of your fund, and sanitize them and feed them to the machine. So the machine is going to have a pattern recognition. Then use the property data, the limited number of historical data the fund has, or limited number of expert interview you can have right now with their investors, and use that to retrain that model to their preference. That retraining, taking the elements of meta learning, transfer learning, requires less data because you have used a massive amount of historical data that is not just for that unique fund you're working with to train a generic machine for investment that picks up on patterns that are not describable by simple metrics, then retrain that through transfer learning and meta learning and few shot learning. These are just engineering methods, engineering like AI methods with few samples from that fund to now have something unique for that fund. And then as they start using the machine through a closed loop feedback, they can retrain the machine better and better. They look at a deal that is picked by the machine. They say if they like it or don't like it, and perhaps what was the reason they liked it or didn't like it. And the machine is going to take that into account, retrain itself.
Got it. And what about X factors? And um, that's not in the data set. Like, for example, I'd say and Philip, maybe you can take this one, is two of the most critical factors that go into helping a business succeed. One is just timing that has been identified. Like if you having a business at the right time in a market is far more likely to succeed than at the wrong time. And then the other is the founding team or the founders or the particular creator of the business and their understanding of a particular market and what's actually going to be a legitimate solution for that market. also that doesn't exist in a data set. So how do you kind of account for both of those things? I get the historic side and kind of extrapolating from that, but what about X factors like those two in particular?
I mean, I disagree a bit with the idea that the data on this is not available, right? I mean, so there are two ways. One is like that there's some data available on this. So I mean, the timing and so on will probably be indirectly be expressed through some of the metrics that this company has, and like kind of data on the overall market. So if you feed both of these things in, the data is probably going to be available, and the machine is going to figure out, oh well, there's going to be a parameter that is the match of like certain things, like from the market data and the corporate data. For the founders and so on, you can put in their LinkedIn that is online. You can put in their CVs. And if you don't have it available, what you can always do is you can also kind of like feed in your own subjective evaluation, right? So you can go and put in some kind of like data that the investor integrates, and it's like, oh well, we have this feeling about the person, or here's like a text that is describing like how I think about the deal. We've also kind of and there we get to the human in the loop. So I don't think, and we don't think that machines are going to completely replace humans in the next couple of years. What is more likely going to happen is people will take this output from the machine, or and also like in different spaces than deal finding, and then they will work with that. So what it will do is just is going to get them 80% of the way, but in like 20 times faster. And then you do the last 20%, but now you have way more time to do it. You can focus on it really. And so investors are going to take this, and then they're going to apply their expertise, and they're going to kind of work with the things that they get. So
Yeah, I think that's a great point, which is just that it doesn't have to entirely replace a human. It's that if we can help investors do their job better, they're going to be better at finding opportunities and investing in the right kinds of deals by having this data available. So I think that's definitely a great point. As you see firms that start to adopt this more, does it become harder to drive alpha for the funds? And maybe Mohammad, you can take this one. Is as more funds are competing with AI models and having more of this data at their fingertips to make better decisions, I would imagine premium assets going at even higher and higher valuations, where you need to turn it around and grow it much faster to actually generate a return. How do you kind of see that?
So the question you asked about the social welfare impact of AI when multiple funds or majority of the funds start to use that, and how is that going to change the industry? That's a great question. There's a lot of research going into that. The vision that we have is that AI, like fundamentally, is going to reduce the illiquidity in the alternative investment. What it means is that now the deals are going to be made faster, right? For example, if you can do your due diligence faster, like, or you can find the deals faster, right? The investment, everything just in a more efficient and timely scale. We have a more liquid market. In the language of economy 101, if you believe in the theory of perfect economy, with less friction in the market, there is going to be better decisions and higher stake for everyone, which means the matching between investors and assets is going to be better done. The price is going to be discovered faster. And considering the element that in private investment, investments are unique. A fund has unique values with an asset. It's if it matches its thesis, its capabilities in turning around the asset, especially with that lens on. I think generally AI is going to have improve the social welfare, better economy, less illiquidity in the market. Naturally, there are some people who lose, but the majority of people are going to win. Now, this is in the stationary state, in the equilibrium. Getting there, the funds will start earlier, obviously are going to have a lot of early move advantage, especially considering that AI has a time to embed, time to learn, time to even like culturally understand it, organizationally understand it, right? That's back to the question you asked me earlier, like which use case they should start. Like even the work we do in AIx2, between the two products we have, the products we have for generative AI, which is faster due diligence, faster document analysis, faster intelligence from data rooms, we do offer that first because they can take it, they can quickly learn it and then win it. Then they go to the second product that Philipp was describing in extents about finding that alpha and predictive models and all the questions you ask. So starting early, I think, has a benefit, but in the stationary state, majority of the firms are going to be the winners.
Yeah, that's a great point. That with more of this data at their fingertips, you can kind of invest with more confidence. That brings more liquidity to markets that currently doesn't exist because deal cycles can take 2 months at times, and sometimes even longer, depending on the type of asset that you're talking about.
Mhm. And one more thing to add to that, Shiv, is that the dynamic we observe for AI is that mega funds, as I said, like any fund above $50 billion asset under management, they have started the AI journey 5 years ago, and they do have some results by now. The small funds are at disadvantage, small and medium size, because data science and having this data science and state of the art R&D is challenging. It's not the bread and butter for investment. So if they don't find a way to democratize AI, let's say, or everyone has an access to that, then we are going to have a more consolidated like industry generally, because those who have the power of AI and can harness the power of these powerful tools are going to basically take the advantages and all the alpha in the market, right? So it's pretty more consolidated market. But if it happens that these tools are available to everyone in a SaaS basis, for example, that can reduce and cut the cost of R&D across multiple funds, that is going to be the stationary state that I mentioned to you, which is higher social welfare for everyone.
Talk about the diligence side and the deal process side, because we've been talking about finding deals and sourcing deals till now. But how does AI get leveraged there to improve this process and make it more efficient, and at the same time move faster as you find a deal that you want to invest in?
Mhm. So, like what Phil said, the power of generative AI is going through a lot of structured and unstructured data and come back with synthesized insights, targeted insights. That's the power of ChatGPT, Anthropic, and others, right? If we can build a product on top of the operating system of ChatGPT and others, because ChatGPT, Anthropic, and others, as is definitely not a product. It's not secure. It's not compliant. It's not even taking all the like large documents that you need to take. It doesn't support like all the functionality that an investor wants. It's not going to be there, right? I always give this example, like using ChatGPT for due diligence is like using a dictionary for translation. It just takes so much time. Having a translator for translation on top of dictionary, or in the language of investment, having a product for due diligence that uses the operating system of ChatGPT and others and suddenly brings a working product with high quality answers to investment, that can be immediately used for due diligence. How? Plug in directly to your data room, deal room, get all the documents, everything you have, and then you can ask targeted questions. Like the way I used to do my due diligence in McKinsey, the way I manage the teams. I sent my analysts and associates a list of 150 questions and asked them to read it, find them against the deal data room that we had, like all the files, 500 PDFs and Excels and others that we have. Read them, find this. Now, obviously, a human, an associate, an analyst that I had at the time, going through them, reading them, and just learning the context takes time, right? But the machine can just do that much more efficiently and bring back those targeted insights in a format that you want, in a final report format. Obviously, there's a human in the loop that's going to check it, like the way that the manager in McKinsey language worked. Like the way I was working, I was checking the work of my analysts and associates, right? So they did the majority of the job. I had to just check and see if there are other questions I should ask, where I should double click, and everything like that. In the same way, the human in the loop, the machine is going to be that analyst and associate, do all the job, and the human in the loop is going to validate the job quickly and answer follow-up questions and target and tailor the outcome for them.
And Phil, this is a good time to switch to you just to help bring this to life a little bit more. As you're kind of going through that, how can you get to those insights that you would want to get through? Because yes, the machine can get through that data room faster, but then there's a ton of context that is layered within that data that a human needs to interpret. So I get somebody is looking through whatever the output is, but how do you get through the diligence process faster with the assistance of AI tools?
Exactly. So it's building on what Mohammed said. So I mean, what you can do is you take all the data that you have on an asset you have on a deal, and then you ask a machine, for example, to go through all of this data and then provide you answers to whatever you want to evaluate on it. So this may be a diligence questionnaire. It might also be that you have data on, for example, if you're a GPay, all your portfolio companies are giving you KPI reports and they're unstructured, and you're asking the machine, oh, can you please tell me from all this unstructured data what is the 15 KPIs that I actually want to look at, like what is it? And in that case, the machine will tell you, well, they're missing information for three of them, and here's the best answer you could come up with for the remaining 12. And that whole process, if you have a kind of a product that's geared towards doing this, that is going to take like maybe 3 to 5 minutes after you set it up first, because you can parallelize all these questions, and ChatGPT doesn't take any time to read all these documents. Then you get a response back, and that's basically then where you have to do the work to make this 100%. So likely this is not going to be as good as what you would get if an analyst is working for 2 weeks, but it's going to be like 80% there. And then you spend the rest of that day basically going through the documents, looking at the sources of what the machine provided you. So in order to make this faster, it should actually tell you what documents it used, what sources they are, so you could look at this and refine the answers. And then you basically spend one day doing something that would have taken 2 weeks, and in the end you get the same result. The other nice thing is, if you're an investor, and you're like, the senior investor in the team, you can actually now check what the analyst provided you, because you can also look at what the machine has generated, and you can be like, hey, what are the issues in this report? What are the issues, like, given this data that I have, is there anything missing? And the machine learning tool that you're using hopefully will also give you an answer to that, and actually makes it much easier to check the process of your analyst then. So both these things, from the both of this, like being faster in preparing the reports and being able to check them better, is what's going to get you to the result faster, and ideally in a higher quality than what happened before.
Do you see this application only in commercial diligence, or do you see it in other aspects of diligence as well, like financial, obviously, but there's also technical and looking at source code and other forms of diligence, like legal? Like, how do you see that translating across these different disciplines of due diligence?
Yeah, so it does translate across those. There are lots of different companies that actually look at these specific use cases, and lots of AI companies who are starting to do that. So far, I mean, the one thing that machine learning and AI is not so good at yet is doing Excel modeling, or creating financial models. That's probably going to be available in 6 months to a year or so. But sometimes, like what we've heard from some of our customers, like the machines, they have some issue determining like specific accounting terms, or specific, like, identifying specific positions in like accounting documents and so on. So that is something that they reported that they tried internally before, and that was kind of a problem. But machine learning is getting better and better, and I think these use cases are going to be fully available in a couple of months. And then you can basically use the same process for any type of diligence.
Yeah, on our side, we do a ton of marketing due diligence with our clients and private equity firms, and we try to leverage automation and other systems as much as possible to reduce the time it takes to get to those insights. So I totally agree with a lot of what you're sharing. One of the crazy data points about this is that on average, on diligence and all the different work streams involved with that, firms spend well north of $1 million, sometimes a few $1 million, depending on the size of the asset. So through this, you see firms becoming way more efficient, I assume.
Yeah, exactly. I mean, I think there are multiple ways in which firms get more efficient. I mean, like, it's probably short sighted to just be like, oh, how much is an analyst is costing me, because what you're doing is not replacing analyst time. I don't think a lot of the firms that's their goal, or that is something that they care about too much. But you make it way faster. That's one of the things. So what is the cost of having a diligence that takes 2 months versus that takes like now a week or so? Well, you're gonna have much less probability that you're losing a deal. You're also gonna not give your competitors time to bid on it, so you might get it at a much more attractive price. So these type of things are more difficult to quantify. Then are you actually, like, now finding risk factors that you didn't find before? That's probably quite valuable. You do save time, so like people can do, like, 5 times more now. And then of course, if you're like especially when you're saying like legal diligence or kind of like commercial financial things where you would go and pay consulting firms millions of dollars, that is probably something that is going to be reduced now. Yeah, so all these different things. Yeah.
Yeah, and coming back to you, Mohammed, what about other areas? When you look at things like optimizing your existing portfolio or deciding when to exit, what role do you see AI playing in those types of instances?
So optimizing the portfolio is twofold question again. Part of that is using this generative AI to understand your portfolio better, get the data that you have and ask certain insight extraction from that, like the risks and others. That's exactly what these generative AI tools can do. And that's basically what Phil was describing. And that's what our products also, that some of the funds we give it to them are using that exactly for that purpose. Now, this other side of portfolio optimization is portfolio simulation, long-term risk analysis, and portfolio correction, right? Like finding the deals, which one you should sell, which one you should buy, which one you should swap maybe. So that part is again back to that predictive AI machine, that recommendation system that we mentioned, right? Being able to run this like different scenarios and analyze the portfolio under those, right? That's the second camp of algorithm that I was talking about. That's one. Now, when it comes to the exit side, like the exit process, like the VDDs and all the like, it's twofold. It's like getting your asset ready, the reverse side of the buy, right? The selling side, getting the VDDs ready, the CIMs ready with the investment bank if you work with them, and then response to the bidders if they have any questions on your asset. So that part is very similar to the due diligence that you do on the buy side, right? So again, the machine, the generative AI, those insight extraction from targeted insight extraction from those deal rooms and data rooms is something that you can do it in the same way, but for the sell side, and then finding the potential uh, good funds that may want to buy from you. That is exactly the predictive AI again. That's the second machine. As you see, like through this investment process, like end to end, you can see the power of both generative AI and predictive AI by defining very carefully and in a sharp way the use case in every step of the investment. You can see how the generative AI and how the predictive AI can come to the picture.
Right. And do you see that on the optimization side and on the exit side, with investment banks and how they play a role in this process, how do you see their role evolving as data is being leveraged more and AI is being leveraged more to figure out when to exit, what value to exit at, like finding potential buyers? There's a lot of redundancy there in terms of what they do.
Yeah, that's a very good question. Yeah, we were at the Finovate conference, and I'm gonna give a keynote speech in their fall version in New York. And I guess Phil is gonna talk on another session on AI for them. And that's exactly the question they ask, like those investment bankers, like what is our use of AI right now, and what is our future role if AI is gonna come to the place, right? It's a very critical question that those people ask, and part of that was asked from me when it was in McKinsey days as well. Like have a vision for the industry. Now, the first question is easier to answer. What kind of AI I can use as an investment banker internally? Exactly the use cases you mentioned, right? Find the good buyers for an asset, like who is the potential fund to approach in a more targeted and uh, individual way rather than just sending the SIM to everyone, right? And just spam all the inboxes. Getting the SIM ready by itself is a lot of work that an analyst do in those investment banks. And that is something that the generative AI can do in the same way that we're talking about document generation and due diligence and targeted insight extraction, all of these things. And this process, like the investment bank does, is very similar, and doing that in a faster way, like in a targeted way, faster way, resulting in a better matching of the market is what the investment bankers can do with AI, right? Now, there's a price discovery as well that you mentioned. It's a very interesting set of algorithms, like price discovery for an asset, which is predictive AI, a lot of interesting engineering work that can happen there. Now, this is just a like short version of the answer. Like, what can AI do in this business? In long run, I don't think investment bankers are going to go away. I think there's a lot of human elements to this business, like matchmaking and deals and convincing the parties, the both parties. That human element for the entire alternative investment is going to stay. We were at Super Return, like in Berlin. There were 5,000 mix of GPs and LPs, just a couple weeks ago, and we had a dedicated session to AIx2, which we presented all of these AI use cases and others. And you can see in that environment, in that conference, just people meeting each other and making handshakes and making like connections. That is important for investment, especially for alternative investment. That is not going to go away with the machine. But now having a more targeted conversation, faster deal processes and others is what makes the entire process more efficient.
Right, right, totally. Yeah. So in essence, the ecosystem stays intact, but it becomes way more efficient. There's less waste. You can move through things faster, cheaper, and get to better answers and have a better chance of driving alpha within your investment. So that's a great way to summarize it. So I think with that said, as I think it's a good place to end the episode as we're coming up on time here. But before we do that, what's the best way the audience, if they want to learn more about what you're up to, how can they learn more about you?
Yeah, definitely happy to. As part of the things that AIx2 is trying to do is to stay in educating the community, the firms, the fund managers. Also, we have our ongoing survey, which measures the pulse of the market, and we see how funds are changing. And there have been massive changes in the last 9 months, massive developments in the community. So we are available on LinkedIn. If people want to reach out, I'm there. Philipp is the same. AIx2 web page is there, AIx2.ai. Just feel free to go there and connect with us. There's info@aix2.com as an email address. There's also our personal, which is mrasouli@aix2.ai and preineke@aix2.ai. The emails you can reach out.
Awesome. We'll be sure to include all of that in the show notes. And with that said, Philipp, Mohammad, thanks for coming on and sharing your insights. I think there's a ton of great takeaways as the investors and founders and other bankers that listen to this episode will take a lot away from in terms of how they run their respective businesses. So thanks for coming on and doing that.
Thanks so much for having us.
Thanks for listening to today's episode. Before you take off, just a few requests from our side. Number one, if you haven't done so already, please subscribe to the podcast on iTunes or Spotify or YouTube or wherever you go to listen to your podcasts. Number two, if you are in the market for due diligence services, strategy consulting, or fractional CMO services, please get in touch with us at www.howtosas.com. And third, please buy a copy of my new book, Exit Ready Marketing. It covers a ton of concepts that we take our customers through, private equity investors, B2B companies, CEOs, operating partners, and marketers. And there's a ton of great value in there that expands on my previous book, Post-Acquisition Marketing, as well. So with that said, I hope you enjoyed today's content, and we'll see you on the next episode.